US job openings hit a two-year high ahead of June's jobs report. Job openings in the US edged up to a two-year high in May, although overall hiring declined, which could point to this week's jobs report coming in softer. Americans are also increasingly telling pollsters jobs are hard to get. 22.5% of people surveyed by the Conference Board agreed with that, the highest in 5.5 years. So what's going on in the US labour market? Paul Hollingsworth is head of developed markets economics at BNP Paribas. Paul, what do you see in the US labour market? We've had some very healthy jobs reports, but are Americans right to think the jobs market is softening?
So our view is that this week we'll see another strong jobs print like we saw last month and an above trend one as well. So we're looking for a 130k increase. To put that into context, we think the break-even payrolls rate at the moment, in other words, the number of jobs to be added each month in order to keep the unemployment rate steady, we think that's between 0 and 20k. So this is a jobs market that is gradually tightening. So we think this is also going to contribute towards a decline in the unemployment rate. We're looking for it to drop to 4.2% this month and down to around 4% by the end of this year. But I think that sort of tension, if you like, is really with the supply and the demand side. We do still see robust labour demand, even if there are some pockets of weakness, but really the supply side is where the weakness is, and that's why we're seeing the labour market gradually tighten.
If you're right then that this number will come in very strong again, what will that mean for the Fed?
So our view since early June has been that the Fed will need to raise interest rates. We're looking for 3 back-to-back hikes beginning in December. And the idea behind that is it's, if you like, an unwinding of the insurance cuts that were delivered in 2025 when concerns about the jobs market were particularly high. Some of those concerns have now eased, and we think the current policy setting is inconsistent with the cyclical strength of the US economy. December is our base case for when they start, but clearly the risks are skewed towards an earlier start to that hiking cycle.
Well, the new chair, Kevin Walsh, is at Sintra, speaking at an international event for the first time in his tenure. He's been non-committal enough since taking office that markets are on tenterhooks for almost anything he might say. But what are you expecting to hear?
So I think the message from the June FOMC press conference was to expect fairly little guidance from the Fed from now. And that's certainly consistent with the relatively limited speaking commitments that we've seen over the past couple of weeks. We don't expect Chair Walsh to give away much in his Sintra speech either. So in other words, I think the key takeaway is that every meeting from here is potentially live.
Well, what about the ECB? We saw inflation come in unexpectedly lower today. Have lower energy prices eased the pressure on them to hike?
It's certainly eased the pressure. We still think another hike is more likely than not, though. As you say, we have seen a bit of a decline this month in inflation and a bit of a downside surprise. We think we can take some signal from that, but also there's some factors that may not persist. Food prices, for example, are quite benign at the moment, but we think that the food price inflation is yet to sort of show the disruption we've seen both from higher energy prices and just in general the disruption from the Middle East conflict. So we think that that will begin to drift higher. And some of the second round effects, which is really what the ECB is focused on now, again, it's too early to see those right now, but we think those effects will start to build over the coming months. And so our view is that the ECB has probably got one more hike before it thinks that it's done enough to contain the inflationary shock.
So it's too soon, you think, to say whether Europe has managed to avoid some of the worst-case inflation scenarios that were expected from the Iran war?
Well, with energy prices having coming down significantly and the disruption in the Middle East also easing, I think the chances of the severe scenarios have clearly decreased materially, but that doesn't mean there will be no second round effects. There was a relatively prolonged period of disruption. Energy prices did climb significantly. So some damage has already been done, and I think we're yet to see the full effects of that. And really, that is what the ECB is now looking at. It's seen some of those first-order effects in things like fuel prices at the pump, airfares, for example. But those second-round impacts on corporate profits or on wages, it'll need to wait a bit longer to see if those effects materialise or not.
That was Paul Hollingsworth of BNP Paribas. Don't forget, you can watch more videos on Reuters.com.